हेलो एंड वेलकम एवरीवन, दिस इज प्रोफेसर सिद्धार्थ सुराना। आई होप यू गाइज आर डूइंग गुड और मैं तो हमेशा मस्त ही रहता हूँ। वेलकम टू एपिसोड नंबर 2 ऑफ MCQs. All the introductory part I have already covered in the first episode, so you can watch the first episode, those who are directly coming to this lecture, to understand how we will be going about the MCQs. We have finished chapter 1 introduction, chapter 2 DTAA and chapter 3 cash loans. Some really important chapters coming up today in this episode. NRI taxation related to international tax, special rates of tax has got so many provisions of international tax, and we are going to cover a good number. Last time I left you early, but today we are going to cover a good number of questions, so be patient and be with me. There may be some questions which are very easy. Just because they are very easy, please do not take them lightly. Okay, so let's go to question number 1, NRI taxation, starting on page number 13. To become a resident. Acha, by the way, in this chapter residential status I cover, so here you will also get questions of residential status. In fact, there is a big case study which was recently released by ICAI, big case study, almost 2 pages. That question is going on, so we will be covering that also in this chapter only. So there are easy as well as difficult questions, both covered. To become resident, following condition needs to be satisfied. 182 days in the 182 days or more in the previous year, yes, it is a condition. 365 days or more during 4 immediately preceding previous year, it is a condition, but 365 alone is not enough. Along with 365, it has to be 60 days, or certain cases where a citizen of India or a person of Indian origin has come for a visit and the income is exceeding 15 lakh rupees, then we apply the condition, but we apply 120 days. So yes, 365 and 60 have to be satisfied together. Correct or no? That means either you do this or you do this and this. Correct or no? So either you do A or you do B and C. A or B and C, and that is what we have to select also. A or B and C. Residential status of an assessee must be ascertained. Is it like that once a resident then every year resident? No. So residential status has to be ascertained every year. Miss Rosemary Smith is a citizen of Canada. She came to India after 10 years on 5th June 21 and left on 3rd December 21. She is dash for FY 21-22. 4 options of course are given to us. See, one thing I can tell you, that if she has come after 10 years, that means last 4 years 365 has not taken place. Last 7 years 730 has not taken place. She is a non-resident in all the last 10 years. That means she can definitely not become ordinarily resident. This is definitely cancelled and it can be determined. So this is not the answer. We just have to check whether she is NOR or non-resident. So we will count her days from 5th June. So in June we will exclude 4 days. June ka we will take 26 days. 30 minus 4. 5th June has to be included. And in December, 3rd June also, 3rd December also has to be included accordingly. For June we will have 26 days. I have already, as I told you, that for saving your time, I have already solved it. June 26, July, August, September, October, November, full period, and December 3 days, because we have to include the incoming and outgoing day. We have to include the incoming and outgoing day. Oh, there is a mistake here. It's not OR. We have to include the incoming and outgoing day, and thus her stay is coming to exact 182 days. Exact. See how important it is. If it is exact equal to 182, then she has become a resident, and we have already decided that she is not ordinarily resident because last 7 years 730 is not fulfilled and all that. If this was just 181 days, then 60 days are fulfilled, but then 365 not fulfilled. So then accordingly what happens is, if 60 is fulfilled and 365 is not fulfilled, then our answer would have been non-resident. But just because of that 1 day ka difference, she has become resident but not ordinarily resident. Question number, so I have corrected that. It was by mistake written ROR, it is RN. Mr. Rustam Pavri, an Indian citizen, left India on 27 June. That means he was here in April, May and 27 days of June. April, May and 27 days of June as a crew member of Indian ship and he has been in India for so many years in the past, from 2018, 19, 19, 20, 20, 21, full year he was here. His salary is 6 lakh rupees. He does not have any other income. What is his status for 21, 22? Listen, he is fulfilling the condition of 60 and last 4 years 365. But a citizen of India who lives as a crew member of Indian ship, that is applicable to citizen of India. And if a citizen of India or a person of Indian origin coming for a visit, then those two cases 6365 is not applicable. So because 6365 is not applicable and 182 he is not fulfilling, accordingly his status is going to become, for the financial year 21-22, he is going to become non-resident. Mr. Abhishek stayed in the territorial waters of India in a ship for the month of April, June, July, October, November, December, March. That's 1, 2, 3, 4, 5, 6, 7 months. Easily he has crossed 182. He is what? Resident, non-resident cannot be determined. See, they are not asking ordinary, not ordinary. They are only asking resident or non-resident. For ordinary, not ordinary, they have to give you past year data which is not given. So, the question is, he has stayed in territorial waters. He has not stayed on the land. But then do we know that the definition of India includes the territorial waters also? So, even if he has stayed in the territorial waters, he will still be treated as a resident. Condition of ordinary and not ordinary resident should be checked for. I have already told you in the past also, ROR, RNOR applies only for individual HUF, does not apply for any other assessee. Income that would be taxable in the hands of resident but not ordinary. See, ROR has to pay tax on all the incomes. NR has to pay tax only on Indian income. But RNOR has to pay tax on Indian income. So, of course, source in India, everybody has to pay tax. Foreign income will be taxable only if the business is controlled from India. Accordingly, this is also taxable, this is also taxable, and thus this is the answer. All income is not the answer, because if his foreign income is not controlled from India, then that will not be taxable. For ROR, everything is taxable, but that's the only difference between ROR and RNOR. One of the conditions to be satisfied for ROR is stay in last 7 years 365, no, 730. Stay in last 7 years 730. That's our answer, because 60 and 700 also is not our answer. Mr. Suresh, a non-resident, received commission of 80 lakhs from an Indian company. This 80 lakh is remitted by him to his sister Sushma, who is a resident. In whose hands will 80 lakh be taxable? See, if the source is in India, then it is Indian income and it will be taxable even if you are non-resident. So, the person who is receiving the income is Suresh, and thus it will be taxable for Suresh. After earning income, what you do with your income? You give it to a sister, wife, mother, father, sister, does not make any difference. It is going to be Mr. Suresh who will be paying tax. Provisions of this chapter, NRI taxation, are, we all know that it is optional. For the beneficial provisions of this chapter, assessee should be, what is the condition? Individual, citizen of India or person of Indian origin, non-resident. Individual, citizen or PIO, non-resident. That means, can I say all of the above? Forex asset includes shares of private company, shares of any Indian company are included. Securities by state government, no, securities only of central government are included. So, accordingly, if they say state government, this answer is not the answer. That means both also is not our answer, and none cannot be our answer, because this is our answer. Just if I change this state government to central government, then C will be the option that we have to select. MCQs is about choosing the most appropriate answer. So, if A and B both are right, then our answer should be C. NRI opting for 10% of LTCG under section 115E shall lose what? NRI will not get basic exemption, not get chapter 6A because it is special rate. Transfer expense ka deduction is allowed, so that he will not lose, and indexation he will lose. That means he will lose 1, 2 and 4. He will lose 1, 2 and 4, which is given in our option B. Tax rates for investment income will be dash and LTCG will be dash. What is the tax rate for investment income? 20% and long term capital gain 10%. So, very easy option, option B. An NRI opting for 20% on investment income shall lose which benefit? On investment income, he will lose basic exemption, chapter 6A, deduction of expenses also. Of course, indexation ka question does not arise. So, for this, the option will be all. To get full exemption under section 115F, the assessee should invest in another forex asset. Within how much time? You should acquire another forex asset within a period of 6 months, but not from the end of the year or from the end of the month. 6 months ka time is counted from the date of transfer. To get full exemption under section 115F, assessee should invest what? Under normal provisions of capital gain, you have to invest the capital gain amount. But in 54F and this chapter NRI, you have to invest the net sale consideration amount. Assessee is not required to file ROI even if income exceeds basic exemption limit. If in this chapter, what are the two conditions? No other income and tax has been withheld. Matlab, this means nothing but TDS has been deducted. The meaning of tax has been withheld is nothing but TDS has been deducted. So no other income, TDS has been fully deducted. Thus it is both of the above. Assessee can opt for NRI provisions even after becoming resident till he holds the forex asset. Yes, once you were non-resident in the year of acquisition, you can be opting for the optional provisions till the time you hold the forex asset. Assessee can opt for NRI provisions even in the new regime. See, what does the new regime say, 115 BAC? That nothing of income tax will be applicable except chapter 12 special rates, and this is chapter 12A. In other words, once you are in new regime, then this chapter 12A will not be applicable. So can you opt in the new regime? No. Chapter 12A is applicable for, we all know, only individual, that also if non-resident and citizen or person of Indian origin. Chapter 12A is applicable for, is it applicable for all incomes? No. Investment income from forex asset? Yes. LTCG from forex asset? Also yes. If these two are right, then actually you will have to choose this as your option. This is what MCQ is most appropriate. If B and C both are right, then you have to select both as your option. I am not saying that B is wrong or C is wrong, but the most appropriate answer will be D. And here comes that big long case study. Long story is given. If you observe, there is one printing mistake also. I'll make you do that correction also of that printing mistake. I have written that already. Here, if you observe carefully, almost more than a page, which spread over 2 pages, is the question only. And after giving you the whole story, they have given you 5 questions. All the 5 questions. The question is, on the basis of the given facts, answer question 23 to 27. So 23, 24, 25, 26, 27 has to be answered on the basis of the story that is given to you. Whenever they give you a case study based question, I have done this discussion in my past lectures also, but for the benefit of those students who are watching my MCQ lecture for the first time, what will happen in a case study based MCQ is, first you will read the full story. Everything is relevant, all the facts given here, all the story you will read, full story. There are 4 people given, Mr. Rajesh, his wife Soumya, and they have 2 sons, Dinesh and Karthik. We will read it, but I am telling you, there are 4 people. And then on those 4 people, they have asked question. What is the residential status of Soumya, residential status of Dinesh and Karthik, total income of Dinesh, total income of Karthik. Of course, residential status of Dinesh and Karthik will decide whether we have to tax Indian income, foreign income, or both. Indian income will always be taxable, foreign income only if they are resident. And what is the residential status of Rajesh? So one thing is for sure, that there are 4 characters in the story and we have to find residential status for all and income of 2 people, the 2 sons, Dinesh and Karthik. That means if they give us any detail of income of Rajesh or Soumya, that may not be relevant for our discussion. Why am I telling you this? What is the trick to get maximum marks in case study based MCQs? By investing minimum time and effort. There is a trick involved. This trick can be risky. So do this at your own risk. The trick is, read the questions first. Now I know the questions. Now I can go and read the story and only decide what is relevant for me. Residential status of Soumya, Dinesh, Karthik and Rajesh, and income of Dinesh and Karthik. I just have to know that much. Of course, income of Dinesh and Karthik will depend on their residential status, and for Rajesh and Soumya, residential status is asked, income is not asked only. What generally people do is, they first read the whole story, mark every line, they dekho, this income, that income. And at the end, they realize that some of that data was not relevant for the questions that they have asked. So to save time, you can first go through the questions so that you know that in general what is the, you may not understand exactly unless you know the story, but to save time you can do that. It may come with a risk, but the risk is worth it because the amount of time that you will be saving will be worth it. So that's one thing. And one more thing, in case study based MCQ, even if they give a big complicated story, if there are 5 questions, 2 or 3 will be very difficult. Like in this question, residential status of Soumya is very difficult. Dinesh is very difficult. Karthik is very easy. Income computation of both of them is very, very difficult. Dinesh and Karthik both. But residential status of Rajesh is very easy. Very easy. Very easy because 1 line के अंदर you will get your answer. So one thing that's a common feature of case study based MCQ is that always you will find 1 or 2 questions very easy. Without reading much in the story also you can give that answer. So they will average out. Couple of questions will be very difficult, couple of questions will be very easy. That's how they will average out the case study. Okay. If they ask individual questions like we have been doing, then individual questions has to be either very easy or very difficult. If they keep it very easy, then it does not make sense to ask a CA final student. And if they keep very difficult, then in 1 or 2 marks, how much we can ask? So they average out by asking case studies. Okay. So let's see. One thing is for sure that residential status is asked. So quick recap of what is residential status. These MCQ lectures are also like an additional revision. How residential status is computed. First, 182 in the current year, then we don't check anything. Second, 60 in the current year, 365 in the last 4 years. But that is not applicable for citizen of India who is going outside for earning. And second, citizen or PIO who is coming for visit. So if you go out for earning or you come for visit. But for that, it has to be citizen of India. And for the person who is coming to India, it can be citizen or PIO, but for visit. And they have tested people, when you read the story, you'll come to know every fact has been tested here. And there is a third way also. If you are a citizen of India and your income is exceeding 15 lakh rupees, citizen of India and income exceeding 15 lakh rupees, and you are not a tax resident in any other country. Citizen, income more than 15 lakh, not a tax resident. When we say income more than 15 lakh, which income we will take? All Indian incomes and foreign income if controlled from India. Indian income and foreign income if controlled from India, and you are not a resident anywhere else and you are a citizen, then that 15 lakh wale condition se bhi you can become a resident. So we will check for all the 4 people, do they fall in any of the 3 conditions? 182, 63, 65 if applicable, and that 15 lakh wala condition. This question was there in the May 21 RTP. I told you that till May 21 RTP everything is covered in this book, and November 21 RTP I have separately released a lecture. May 22 and November 22 RTP will also be uploaded on YouTube. One thing I would like to tell you, at that time it was a recent amendment. So when we did the residential status of Soumya, the answer was right only, but the discussion was a little different. And now that there is clarification by ICAI in all the questions they have given, you should ignore that solution which was given in the May 21. Ignore that video and focus on what I am doing now. This is the correct way of doing it. So let's see what do we have. Rajesh is age 53 years, Soumya is 50 years. Age is irrelevant when we talk about computation of income or residential status. Only in tax calculation it works. Anyways, they are not senior citizens. They were born in India. They were living in India till 2001, that's 20 years ago, where they moved to country X and settled there permanently. Since 2011, they have become citizens of country X. Means, listen, at this stage only I can clarify one thing, that 15 lakh wala condition, not being a resident anywhere else, then you will be resident here. That cannot apply because that is applicable only to citizens. They are foreign citizens. That condition cannot apply to these two. So now for residential status, we will check only 182 and 6365. 6365 also if it is applicable. Correct or no? They have 2 sons who are twins, Dinesh and Karthik, who are also citizens of country X. Areva, very good. That means one thing is for sure. For all the 4 characters, that not a resident anywhere else, but income is exceeding 15 lakhs, so you will become resident. That cannot apply because that applies only to citizen. You saw on one word they have tested you. That means one thing is for sure. All 4 people ka residential status is asked. That is the beauty of reading the question first. If we know the question, we know what to interpret here. If we directly started with the story, then we would have never realized the importance of these lines. And that's the trick, that's the idea, that is how you can get maximum marks in MCQs. Correct or no? So focus. All 4, that 15 lakh wala residential status cannot apply. Okay? Because that is applicable only to citizen. They completed their schooling in an Indian school, but in that country only. Thereafter, in 2016, Dinesh joined mechanical engineering in IIT Delhi, and after completing engineering, he took employment in ABC Limited, a multinational company in Gurgaon, at monthly salary of 1,50,000 for September 2020. Means, in other words, can I say Dinesh is now working in India? He is a foreign citizen, but he is working in India. September 20 say he has joined, but of course our exam ka previous year is 21-22. We will focus only on 21-22. Dinesh visits his parents in country X for 1 month every year, and for the rest of the year he is in India. I think I have found out the residential status of Dinesh. 1 month he is going, rest of the time he is in India. That means 182 he is fulfilling. Last 4 years also. 4 years is not relevant. 4 year ka 365 is not relevant. Last 7 years ka 730 also he must be fulfilling because he is here since 2016. And he is a resident in all the years. Dinesh, I am sure now he is ROR, but we will do the computation of number of days. Karthik completed his architecture in our College of Architecture in country. So Dinesh was studying here and Karthik was studying there and took up a job in LMN Incorporation, San Francisco. So Dinesh is working in India, Karthik is working in San Francisco in 2020 for monthly salary of $5,000. So Karthik stays in San Francisco working over there. Dinesh stays in India and working over here in India. Rajesh has a textile business in country X and Soumya is a Carnatic musician who does concerts in country X in music programs organized by Indian community in this. So Rajesh has a business and his wife Soumya, mother of Dinesh and Karthik, she is a musician. Okay. Rajesh visits India for 1 month every year to be with his parents who were born in Coimbatore and have always lived in Coimbatore. Coimbatore is a city in Tamil Nadu. It is a big city next to only Chennai in Tamil Nadu. But I think I have also determined the residential status of Rajesh. Rajesh comes only for 1 month. That means he is neither doing 182 nor he is doing 6365. 6365 I am not even checking the applicability. He is not doing only, then why I should check? Correct? And that 15 lakh wala condition cannot apply because he is not a citizen. I think I have decided that Rajesh is a non-resident, Dinesh is ROR. 2 people ka answer I have already found out. Understood the importance of reading the question first. Very good. Details of his income for previous year 21-22. Textile business is given. You may assume that the currency is to hell with you. Is Rajesh ka computation asked? No. Even if it crossed 15 lakh, will we apply that condition? No, because he is a foreign citizen, that not a resident anywhere else. Therefore, a resident here rule is applicable only for citizen. He has already a non-resident. That means Rajesh ka income detail is irrelevant. Rental income from property in Coimbatore 60,000. Interest on FD with SBN. All this is irrelevant. All this is irrelevant. Do you understand the importance of reading the question? So I think I have decided Dinesh is ROR, Rajesh is non-resident. Let's go ahead. Country X does not levy tax on the income from business of textile in order to give a fillip to textile industry in that country. Country X also does not levy tax on income earned by resident of country X outside India. That means this line is basically telling us that Rajesh ka income in country X is not taxable. He is not liable to tax over there. This is purposely given. You know why? Now what students will do? They will count Indian income 60,000 per month. This is also 10 lakh rupees. Plus foreign income is covered only if control from India. So this you may not take. But 60,000 per month you may take. And then you will check that this 10 lakh but this amount is exceeding rupees 15 lakh. And thus, if it is exceeding 15 lakh and he is not paying tax in any other country, then he will become a resident. This may give you a feeling that Rajesh is resident. And in that 15 lakh condition, it is always not ordinary. But we have cleared in the beginning only that that is applicable only to citizen. And once that is applicable only to citizen, topic is over. Rajesh is a non-resident. This is also given only to confuse you. Only to confuse you. Correct? Now, details of Soumya are given. So, Rajesh and Dinesh ka we have determined. Soumya and Karthik ka we will have to check. During previous year 21-22, Soumya visited India from 3rd October 21 to 31st January 22. She was in Trichy during the months of October and November. So 3rd October to November she was taking care of her ailing mother in Trichy. And during December and January she rendered Carnatic music in the Margazi Mahautsav organized in the various music academies in Chennai. And every year she is in Chennai entirely during these 2 months for this purpose. Then you have to add this line. She also visits her ailing mother every year for the full month of May. You add this line also. You add this line. Okay. At year. She also visits her mother every year. That means listen. Details of Soumya are given. This year he is here. This year she is here from October to January. October, November she was with her mother. and December and January she rendered Carnatic music. She did performances. Ladies and gentlemen, 182 days ka condition I think she is not fulfilling because October, November, December, January only 4 months. Correct or no? 182 she is not fulfilling. Okay. 6365 is not applicable. And that 15 lakh wala is to not applicable because she is foreign citizen, that we have decided. 6365 ka applicability. This is what I am telling you, that at that time the interpretation was a little different about that 120 days. So you ignore that and you focus on what I am saying right now. 6365 is not applicable to whom? Citizen of India or a person of Indian origin. She is not a citizen of India, but she is a person of Indian origin because she was born in India, who comes to India for a visit, and she visits her ailing mother, but then she is also earning income. Once you earn income, that means you don't fall in the exception. You will be covered in the condition of 6365. You will be covered in the condition of 6365. 6365 is going to be applicable. 6365 is going to be applicable. So current year we will take October, November, December, January. From 3rd October to 31st January we will be taking to check 60 days are fulfilled or no. We can see it is fulfilled. And then we will take last 4 years. She comes, every year she comes during these 2 months. That means this will help us for last 4 years. Plus she is also here for the month of May. So this year in 21-22, the question is silent whether she is here or she is not here. But anyway, 60 is fulfilled in this much only. So even if we ignore the month of May for 21-22, in last 4 years they have clearly told us that she comes here every year in the month of May. So in current year you can ignore the month of May because they have given that she came from, and this is the period where she took care of her mother. So this year she came from October to January. Her performances are only in December, January, but she came in October, November for taking care of her mother. So this year whether she came in May or no, you can ignore or you can take, but it won't make any difference because anyways 182 is not going to be fulfilled and 60 is already fulfilled with this much period. But the month of May will definitely be relevant for the last 4 years. We will be taking May and December and January because she comes every year during these 2 months for this purpose. So we will check 6365 and then we will check last 7 years and we will also check last 10 years, and with this we will be able to decide the residential status of Soumya, which is actually our first question. She also has house property in Trichy which she has let out for 40,000 per month. Municipal taxes are given, income from concerts are given, 9 lakh interest on fixed deposit with Indian Bank in Trichy branch. See, listen, if we had to apply that 15 lakh ka condition, no, then we would have taken her incomes. Okay, if we had to apply that 120 days. So this is what I am taking. This was a small error. I apologize for that. If we had to apply that 120 ka condition, 120 ka condition is applicable only for those people to whom 6365 is not applicable, but they have income exceeding 15 lakh. 6365 is not applicable, but they have income exceeding 15 lakh. But here 6365 is applicable because she is not coming for visit. She is coming here for the purpose of performances. So over there also it is not relevant. So incomes of Soumya are not relevant and they are not even asking her income computation. Now Dinesh ka details are given. Actually if we want we can first compute the residential status of Soumya, which is the first question, and it will be done from this paragraph only. But let's finish the story and then one by one we have decided that here we have details of Rajesh in this paragraph, then we have details of Soumya, then we have details of Dinesh, and then we have details of Karthik. Dinesh resigned from his job in ABC Limited on 20th September and took up an offer for employment in MNC Incorporation in New York. Means Dinesh is leaving his Indian job and going earlier. Remember, he was in India at a monthly salary of 1,50,000, but he is leaving this and now joining USA at monthly salary of $7,000 US. Okay. He has submitted his resignation on 20th August and thereafter he served a 1 month notice period as per condition. That means he left the job on 20th August. Means resignation was given in August, but he continued to work till 20th September. That means he must have received salary from 1st April to 20th September on the basis of that 1,50,000 that is given to us. And then he left India on 28th. So when you compute residential status, you have to take April, May, June, July, August and 28th September. Even if he stops working on this date, but he was in India till this date. and joined MNC incorporation on 1st October. So he joined his foreign job from which date? 1st October, and apart from that he has got 40,000 interest from fixed deposit. It is FD interest. FD interest. See, Dinesh ka income computation is asked. So we have to take his Indian income 1,50,000 per month till 20th September. Then foreign income we will take only if he is resident, otherwise he will not take. We will check his residential status, because now if he has left on 28th September, so we have to check. Earlier we were thinking that full year he was in India, but we will have to check. But this 40,000 also being Indian income is going to be taxable, and this is FD. Listen, we are asked total income. If this is saving account, see how deeply they have tested you. If it is saving account, then we have to take 80 TTA. But in FD, only senior citizen get TTB, and parents are only 53 and all. So of course they will not get 80 TTB. Yeah. And now Karthik. Karthik resigned from Element. Remember, Karthik was working in San Francisco to join PQR in Mumbai. Kya chaos hai bhai. Dinesh is leaving Indian job and going outside. Karthik is leaving foreign job and coming to India. He came to India on 2nd December. That means his stay in India, we will start counting from 2nd December, and he joined PQR on 5th December. His salary will start from 5th December, but residential status ka counting will start from 2nd December. Karthik ka bhi they have asked residential status and income both. His salary in PQR Limited is rupees 99,200 per month, which will start from 5th December. If you understand, Dinesh ka salary will end on 20th September and Karthik ka salary will start on 5th December. In India we are talking about. He used to visit his maternal and paternal grandparents in India for 2 months, July and August, during his summer holidays up to 2019. So in the past years, he used to come to India only for 2 months. Only for 2 months. Correct? And in the year 2020, he visited for 1 month only. That means, earlier years he used to come for 2 months, but in 20 he came only for 1 month in July. This will help us to calculate his past years ka stay. If he is, we have to decide his residential status. No, current year ke andar 6365 will be applicable or no. See, for Mr. What's the name of the father? Rajesh. No, Rajesh to comes only 1 month, so his topic is to already over. For Soumya, 6365 is applicable because she is coming for income. For Dinesh, listen carefully. Will 6365 apply? Let me discuss that also. Citizen of India going outside for earning, then 6365 is not applicable. Citizen of India, and he is not a citizen of India. See, they have tested you on the basic. Is he citizen of India? All 4 are non-citizens. That means that 6365 ka exception is not applicable. In other words, 6365 ka condition will be applicable. If you are citizen going outside for earning, then that 6365 is not applicable, but he is not a citizen, so 6365 will be applicable. And Karthik is to coming for income. He is not coming for visit. Earlier he used to come to visit, but now he is coming for income. And thus, can I say that 6365 ka condition will be applicable. Rajesh has to not come to India only except that 1 month, so he is definitely non-resident. But the remaining 3, Soumya, Dinesh, Karthik, all the 3 cases 6365 will be applicable. Why on Soumya? She is coming for income. Why on Dinesh? He is going outside for earning, but he is not a citizen. And why on Karthik? Because he is also coming for income. And he has 9,500 from saving account. Saving. Understand the difference. You will be computing income of Dinesh and Karthik both. Soumya ka we are not computing. Dinesh is FD interest, so we will not give any deduction. But Karthik ka it is saving account interest, and if it is saving account interest, that means we will be computing 80 TTA ka deduction also. The telegraphic transfer buying rate of US dollar on the various dates is given. They have given you the rates of US dollar. Why it is relevant? Let me give you a small explanation. Whenever you are a resident, you have foreign income, it will be taxable. If out of Dinesh and Karthik anyone is resident, then their foreign salary, one of them has got $5,000 per month, one of them have got $7,000 per month. That will be taxable. We will have to convert into Indian rupees. Salary, I am telling you a rule. Salary is converted at the exchange rate on last date of previous month. Salary is converted at the exchange rate on the last date of the previous month. That means if you will take April ka salary, it will be converted into Indian rupees at this rate. May का salary at this rate. Last date of the previous month. June, July, August, September, October, November, December, Jan, Feb, March. Salary is converted from foreign currency to Indian currency. Of April का salary at 31st March. May का salary at 30th April. Last date of previous month. Exchange rate on the last date. So between Dinesh and Karthik, whomsoever ka income we have to take as taxable in India, this is the conversion rate. Only if they are resident that we will answer and we will come to know. Your answer should be based on the provisions of Income Tax Act. Ignore the provisions of DTAA. As anyways, DTAA ka provision is not given. Bro, welcome to MCQ lecture. Those who were thinking in the episode 1, sir, kya itna easy question. Now you understood why you have to watch all the episodes. Let's discuss. I have solved the sums for you so that in the lecture we consume less time. What is the residential status of Mrs. Soumya for AY 22-23? So Soumya ka data is given here. Okay. Let's see. What is the residential status of Soumya? In the current year 21-22, she came here on which date? 3rd October. So we are going to take October ka 31 minus 1st and 2nd. Mind you, the incoming day 3rd October will be included. Always remember that the incoming day has to be included. So October ka 29 and November, December, Jan. She was here for these months, these 2 months with her mother and these 2 months performing. In fact, these 2 months she comes every year and May she comes every year. With these 4 months, her current year stay in India is 120. Now, this is what I was telling you, that in this year, that way, there is one line which I told you to add, that every year she comes to India in the month of May to take care of her mother. But this year they have said she came on this date. So she took care of her mother in October and November. So you have got 2 options. You can assume that this year also she came in May. Then you add that May ka 31 days. That will make it 152 days. And assume that the question is saying, no, this year she came in October only to take care of her mother. Then you ignore this. And 121 days. But anyways, 182 she is not fulfilling. And 63, 65 is applicable, we already discussed. So 121 loja 152 does not make any difference. You can take that assumption. Okay. So this year ka May you take or you don't take. But last 4 years ka we will take May, December and Jan. May, December and Jan. That is 93 days into 4. So last 4 years 372. So current year ka 60 and last 4 years 360, 365, 60, 365. Therefore she is a resident. One thing we are clear, Soumya is a resident. Income is not asked, but Soumya is a resident. And now we have to check ordinary or not ordinary. Okay. She is in India for 93 days every year. And plus every year she must be fulfilling 365. So that way she may be a resident in all the 10 years. But one thing we know, that last 7 years, if we check 93 into 7, so she is in India only for 651 days. So last 7 years ka 730 she is not fulfilling. And thus Miss Soumya ka residential status will become resident but not ordinarily resident. 63, 65 she is fulfilling. May ka you can take an assumption. This year they have given October onwards she is here. So May she may or may not be here. If you want to say that every year she comes, then you can take also. Still 60 is being fulfilled and last 7 years ka 730 not fulfilled. So she is R NOR. What is the residential status of Dinesh and Karthik? They are asking both. Dinesh and Karthik. Okay. So both are non-resident, or one is ROR, other is RNOR, non-resident and RNOR, ROR and NR. What is the residential status of Dinesh and Karthik? In fact, answer to 24 will be able to help us to answer 25 and 26. So let's solve for Dinesh and Karthik one by one. Dinesh left on 28th of September. Dinesh ka data is given here. He left on 28. In fact, so many years he was here only. Since 2016 he has a job. So he left on 28 September. That means, can I say April, May, June, July, August, September ka 28. If you add all of them, it is अरे एक दिन और रुक जाता bro. 182. Then he would have been definitely resident. It is 181. 181. But did I already discuss with you that 6365 is applicable because he is not a citizen. 6365 is not applicable for a citizen going outside for earning. For a citizen going outside for earning, he is not a citizen. So 6365 is going to be applicable. He is not a citizen. So 6365 is going to be applicable. So current year mein he is fulfilling 60 days. And if you observe, since 2016, he was majorly here only. No, here itself they told you that Dinesh joined and thereafter every month, every year, 1 month he used to go. Other than that, rest of the year, he used to be here only, so about 330 days every year. So last 4 years ka 365 is fulfilled, last 7 years ka fulfilled, every year he was resident, and thus Dinesh was majorly in India. You don't need to do individual computation. Dinesh will become ROR. Once Dinesh is becoming ROR, if you understand, this option gets cancelled. This option gets cancelled. Now in B and D, Dinesh is given as ROR. But what about Karthik? If you see, Karthik came from outside India. So for Karthik also 6365 is applicable. But let's check. Karthik came on which date? He came on 2nd December. So stay will count from 2nd December. Salary we will count from 5th December. So in December, 2nd has to be included. So only 1st December will be excluded. Subtract 1. So December ka 30. Jan, Feb and March. That's 120 days. 6365 is applicable because he is coming for income, not for visit. Correct? Now we will check last 4 years. 17, 18, 18, 19, 19, 20, 20, 21. They have said that from 2000, every year he used to come for 2 months during his summer holidays till 2019. That means in the last 4 years, till 19 he used to come for 2 months. July, August, July, August, July, August. But in 2020 he came only for July. That means July, August in 17, 18, July, August in 18, 19, July, August in 19, 20, and in 2021 only July, because he did not come in August. So that will make a total of 217 days. So last 4 years he is not fulfilling. He is fulfilling 60, but last 4 years 365 is not fulfilled. 182 is not fulfilled. 6365 is not fulfilled, and 15 lakh ka criteria not applicable because they are all foreign citizens. Accordingly, Karthik becomes non-resident, and thus our answer will be Dinesh is ROR, but Karthik is non-resident. Option D. Now this will help us to do the computation of both brothers. In Dinesh, if he is ROR, do you understand his Indian salary of 1,50,000, and then when he got his foreign job at what? US dollar 7,000. That will also be taxable. We will have to convert, for which we will use the conversion rate. Last date of previous month. He joined the job from 1st October. That means for October ka salary we will take September ka rate. November ka salary we will take October ka rate. We will do this $7,000 from October to March. Plus that Indian salary of 1,50,000. Plus 40,000 fixed deposit, and without any deduction because it is FD interest. They have tested you on so much detail. Let's do the computation. That's our third question. Income of Dinesh under regular provision means he is staying in the old regime. Let's take. We will take salary income of India and foreign because he is ROR, and interest income. What is the income? Indian salary. April to August he will get full salary. April, May, June, July, August. Full salary. See, 20th August he resigned, but he worked till 20th September. So April to August ka salary will be 7,50,000. September ka salary 1,50,000, but he will not get full because he worked only for 20 days. So September ka only 1 lakh. See, one step it is possible to go wrong. If you take full salary, you will go wrong. If you take only till August, you will go wrong. So Indian salary will become 8,50,000. Foreign salary will be taxable because he is resident. So all the months, dollar mein it is 7,000. But we will have to multiply. Now see, October ke liye we will multiply September ka, 30th September ka rate, November ka this, December, Jan, Feb, March, last date of the previous month. Accordingly, 70, 70.4, 71, 71.3, like that we will multiply by the respective exchange rates, and we get this total 29, 86, 200. So Indian salary, foreign salary, total will come to 38, 36, 200. And now some students will add interest income in this. Bola sir ho gaya, khatam, tata, finish, bye bye, gaya. In salary income they are also expecting you to know the standard deduction. So calculate the standard deduction also, and that's your net salary. Add FD interest, and finally you will get your taxable income as 38, 26, 200. Check, do we have 36, 20, 38, 26, 200? Yes, option B will be your answer. They have tested you in every detail. Standard deduction. TTA not available because it is FD. In Karthik we will give because it is saving account. If he was senior citizen, then we would have given TTB. They have tested you on 20 days ka salary. Every minute detail is being tested. He is a foreign citizen. So 63, 65 applied. Otherwise residential status would have changed. Foreign income only would have not been taxable. This full answer would have been changed. Every minute detail is relevant. Similar manner we will check the income of Karthik. Now see, Karthik we have already decided that he is a non-resident. So Karthik के लिए that foreign का income we will not take, we will take only his 99,200 का salary that he is getting, and this 9,500 even if you take an income you have to minus, because it is saving account up to 10,000 you get deduction. See, this is not a place where you have to give proper solution, you have to choose only your final answer. So we all know that 9,500 will get added and subtracted. You are not solving a sum, you are only choosing the MCQ. Okay, so we will calculate his Indian salary at 99,200 per month, but this also from 5th December. Now understand, December has 31 days. 1, 2, 3, 4. 4 days he will not get salary. That means December he will get from 5th to 31 only 27 days. Here 1 day ka also you can make a mistake. 27 days ka salary he will be getting. So for December salary we will take 27 by 31, 86,400, and from Jan to March 3 months he will get full salary 99,200, 384. If you miss standard deduction in the previous year, you may go wrong here. So you will take 50,000. 334 will be your answer. Agar residential status wrong hota, then this also would have been wrong. If residential status mein you would have said resident, then that foreign ka income $5,000 also had to be taxed, and interest within 80 TTA limit. So this will become my final answer. Karthik ka answer will be taxable income of 3,34,000. There is a printing mistake in question number 26 ka answer. It is printed as B. Printing mistake. It is going to be answer C. This will be answer C. So just correct this mistake. And finally, this is that easiest. So this is something that you don't have to check. Residential status of Rajesh. He comes only for 1 month. So he is not fulfilling 182, 63, 65, and he is a foreign citizen. So that 15 lakh condition not applicable, and thus Rajesh will be a non-resident. Welcome to case study based MCQ. This is how you are going to be doing it. I hope you have understood what's in store for you and what is coming up for you. So take these lectures very, very seriously. In the second episode itself, it has been proven that how dangerous this game can get for you and how minutely they will test you. Khali bolne ke liye it is MCQ. It is like full solving of subjective questions and getting only 1 mark for it. And one step also you go wrong, that means you lose that. Subjective mein at least steps ka you get marks, no? All the people who did dharna, DRI, CI, please change. At least in subjective something you would have got. Here you will lose full marks. So take the MCQs very seriously, please. You understand 30 marks can make a lot of difference. Okay, and 1800 MCQs, if you practice only this much, plus that December 21 RTP, May 22, whenever the lecture will be uploaded, you understand that this can solve a lot of problems in your life. Let's go ahead, next chapter. Which of the following is taxable income? Unexplained cash credit, investment, unexplained money, all of the above. Some are like, sir, abhi maja nahi aa raha hai, do similar questions. Nahi. All types of questions you will have to. Amount of 45,000 was credited in the books of Ali, for which Ali did not provide any explanation to the satisfaction. 45,000 was considered as income. What will be the basic tax? For unexplained income, we all know that the basic tax is 60%. Surcharge is compulsory, 25%. Mr. Nitin, a non-resident, sold his property situated in Kolkata to Mr. Raj, a non-resident, and capital gain is 40 lakh 50. Nitin also provided technical services to Manish Limited, an Indian company, which will be utilized for purpose of its business in Singapore. For these services, Nitin charged 10 lakh. What is the income? See, even if the property is sold to a non-resident, the property is situated in Kolkata, income arising in India, 40 lakh 50 will definitely be taxable. But as far as technical services is concerned, if you provide it to a resident, it will be taxable in India. But if that company is using the services outside India, Singapore, then it will not be taxable. The royalty FTS ka rule is they will be taxable only if the services were utilized in India, and thus being utilized in Singapore, that will not be taxable. Accordingly, 40 lakh 50 will be only taxable, and thus 40/50 will be your answer. Meet Darji, a non-resident, received dividend of 2 lakh 80 from Indian company, commission of 3 lakh from ABC LLP, and salary received in Malaysia of 9 lakh for services rendered in India. What is the total income? 2 lakh 80 dividend from Indian company, sources in India. This is also Indian LLP. Commission received, where it was used not given, so you have to assume it is in India. And here also services rendered in India. So I believe 9 plus 3 plus 280 full 14 lakh 80 has to be taxable. Ms. Preksha Surana has earned rupees 5 lakh in the form of royalty income from patent developed and registered in India. She incurred expenses of 2 lakh 60. She exercised the option of 115 BBM. What is the total tax payable? Please understand, when you exercise the option of 115 BBM, you will get 10% tax, right? but you will not get deduction of expense. So any student who has applied tax on 24,000, 2,40,000, gaya. Any student who has applied, they taken deduction of expense, gone. You have to apply. Special rate is always on gross income, no deduction of expense. 10%. So on that 10%, once you add cess, you will get 52,000 as your answer. Income by way of LTCG arising from transfer of global depository, ADR, GDR ka without indexation, 10%. 115 BBA provides that by total income of eligible assessee includes any income by way of royalty in respect of patent developed and registered in India, then such royalty shall be taxable at a rate of, we did 10%. Who is not required to pay STT, CTT? Company, government company, individual? No. Unit located in IFSC, they get immunity from applicability of STT and CTT. What are the benefits available to unit located in IFSC? Short-term capital gain 111 without STT, yes. Exemption of LTCG up to 1 lakh without STT, yes. Rate of MAT 9, yes. That means all the benefits will be available. 115 BBG allows 10% concessional rate on transfer of, we all know, carbon credits. ABC Limited, an Indian company, holds a 27% in D Limited, a foreign company. It received a dividend of 49,000 and expense incurred was 10,000. The dividend income taxable will be. Just decide one thing. Is it normal rate or special rate? Whenever we hold 26 or more, exact 26 is also covered in a foreign company, then we get a concessional rate of 15%. And once we get a concessional rate of 15%, we will not get any deduction of expenses. If this holding was less than 26%, then it is taxable at normal rates. Then we get deduction of expenses and we'll pay tax only on 39,000. But because it's a special rate, we will pay tax on entire of 49. Dividend received by Indian company from specified foreign company as per 115 BBD is taxed at 15%. What is a specified foreign company? Specified foreign company means company in which Indian company holds, abhi to bola, how much? 26 or more, and remember exact 26 is also going to be covered. Section 115 BBD, that is concessional rate at 15% for dividend received from specified foreign company, is applicable to whom? This is applicable only to Indian company. Mr. Akhilesh, a non-resident citizen, non-resident Indian citizen, is an enthusiastic sports person and is keen on contributing articles in game of hockey in a leading newspaper in India. He approaches you to inquire on taxability of such income on AY 22-23. As per provisions of income tax, such income shall be taxable. You may think, sir, वो articles लिखा ना, foreign national sportsmen, sports association and entertainer for sportsman, game or sport, he sportsman, non-resident foreign national, then only that special rate is applicable under 115 BBA. Otherwise, normal tax slabs will be applicable. Nazar hati, durghatna ghati. Be careful about every word. One word you miss, translate karna. South Indians don't worry. One word if you miss, it is disaster. Hindi mein hum bolta hai, nazar hati, durghatna ghati. Savdhani hati, durghatna ghati. Mr. Sam, age 40 years, a US football match referee, has earned income from football tournaments in India for AY 22-23. What is the TDS provision applicable to him? Will we apply 20.8% as per 115 BBA ka TDS, which is in, remember 115 BBA is the rate of tax and 194E is the rate of TDS. Will we apply that? Will we apply that? Huh? Nahin, because match referee is not covered. Calcutta High Court decision of Indcom. Match referee is covered in normal rate, and if it is covered in normal rate, then 195 ka TDS will be applicable. Delta Limited, a domestic company, declared interim dividend of 85 lakhs for 21-22 and distributed the same on 27 June 21. Mr. Ganesh, holding 15% shares in Delta Limited, received dividend of 12.75 lakh in June 21. Mr. Rajesh, holding 10% shares, received dividend of 8.5. Which of the following statement is correct? Dividend distribution tax is attracted in the hands of Delta. See, about 2-3 years ago, DDT was applicable. Now, company will not pay tax, shareholder will pay tax. DDT is attracted, again wrong. Dividend distribution tax is not payable, that's right. Also, dividend by Ganesh and Rajesh is not taxable, that's wrong. Because the company is not paying tax, the shareholder now has to pay tax. DDT is not payable by Delta, correct. Dividend is taxable in their hands, absolutely correct. Ms. Geeta, born in USA, comes to India for the first time on 5th Jan 22 and left India on 28 May 22. She was born and brought up in USA, but her grandparents were born in Karachi, means she was PIO before 1914. In December 2017, she bought in foreign currency 500 global depository receipts of PQR Limited, an Indian company, which were issued in accordance with notified scheme of central government against initial issue of shares of PQR Limited on January 22. She sold 300 GDR outside India to Mr. Frank, a resident and citizen of country X, citizen and resident of country X, and 200 to Mr. Kamal, a resident but not ordinary resident in India. Comment on the tax consequence. She is a non-resident. Now she is earning capital gains. The asset that she is selling is ADR, GDR. Whatever she has sold outside India is income outside India. So non-resident foreign income not taxable. Whatever she has sold to Kamal in India will be taxable accordingly. On 300 shares there will be no capital gain. 300 GDR there will be no capital gain. The ones which were sold to Frank and the ones sold to Kamal will attract capital gain. So capital gain on 500 will be taxable, wrong. No capital gain on 500, wrong. No capital gain on 300 which is sold to Frank, and capital gain on 200 will be taxable. In the above question, if all the GDRs are sold in India, if the sale transaction takes place in India, that means the income has arisen in India. That means all of that is going to be taxable. And for sale of GDR, we know 10% without indexation benefit. Under section 115A, deduction of chapter 6A will be available against. And normally deduction is not available against special rate, but here we will get against which income? Only royalty, FTS, only royalty. So interest nahi, royalty yes, FTS yes. So most appropriate answer, if B and C both are right, then you have to choose D as your option. Tax rate of FII for short term capital gain under 115 AD is, there are two rates given. If covered under 111A, then 15, otherwise 30. So 15, 30, both A and B depending upon payment of STT. Casual winnings are taxable at 30% for, very easy, all assessees. Condition for assessee covered under section 115BB for being exempt from filing of ROI despite having income exceeding basic exemption limit. Don't file ROI even if you have income exceeding basic exemption limit. Some people say, sir, no other income, TDS fully deducted, so C will be the answer, both A and B. No other. Mar gaya. Condition is available for 115A, AC, BBA, sportsman, and 115G, NRI. A, AC, BBA and G, NRI. For casual winning wala section, facility is not available. Savdhani hati, durghatna ghati. 115 BBA is applicable to non-resident, sportsman, sports association, entertainer, umpire. Umpire is not covered. That means, can I say 1, 2, 3 will be our answer? So option to be selected will be D. Condition for assessee covered under section 115 BBA for being exempt from filing ROI despite having income exceeding, BBA is covered. So no other income and TDS fully deducted. So here we will choose our option C. Assessee under which section are exempt from filing of ROI despite having income exceeding basic exemption. This is NRI. These two are special rates, and 115 AC is also covered in special rates. So here it is all of them. Once the option under 115 BBF is opted, it has to be continued for minimum period of 5 years. But if you opt, wait. Savdhani hati, durghatna ghati. Minimum 5 years. But do we know the full rule that in between it is not compulsory, you can leave, but then once you leave, then it will not be available for next 5 years. So if you directly choose 5, that will be wrong answer. 5, but the rule is not compulsory to continue, but if you leave in between, then you lose for next 5 years. See, that way if I would have given the option as 1, 2, 3 and 5, then the most appropriate answer is 5. 5 is right, I am not saying 5 is wrong. But between the 4, what is more appropriate? 5 is right, but this is better. MCQ is always observe any MCQ that institute, they give the heading, choose the most appropriate answer. So if I give 1, 2, 3, 5, you choose 5, then you are right. But here they are saying that not compulsory for 5, you can leave in between, but not available for next 5. So most appropriate answer will be this, and this has to be selected as your option. Knowledge based industry and service under 115 ACA covers chartered accountant, nahi, civil engineer, nahi, entertainer, IT software, IT service, pharmaceutical, biotechnology, entertainer, any other, notify. Nadal, a tennis professional, non-Indian citizen, participated in India in a tennis tournament and won the prize money of 15 lakhs. He contributed articles on the tournament in a local newspaper for which he was paid 1 lakh. He was also paid 5 lakh by a soft drink company for appearance in TV advertisement. Although his expenses in India were made by sponsors, he had to incur 3 lakh towards travel cost. He was a Ding. What would be his tax liability? Some students are wondering, sir, ये तो full course में जो subjective questions we did in class, same ना? Na munna na. This is a resident, and thus 115 BBA is not applicable. 115 BBA is applicable for non-resident foreign national, non-resident foreign national, non-resident foreign national. 115 BBA will not be applicable. अरे समझा क्या? 115 BBA will be applicable only if you are a non-resident foreign national. So normal rate will apply. What are the mistakes? If you apply special rate, you are wrong. You apply normal rate by saying no deduction of expense, because in normal sums you don't get deduction of expense under special rates. No, here he will get deduction. One thing is very clear. Normal rate, that means deduction of expense. So we will take 15 lakh, 1 lakh, 5 lakh, total 21 lakh. We'll give deduction of expense 18 lakh, and on that 18 lakh we will calculate tax at normal rates. And that also, listen, when the question is not giving information about any exemption, deduction or anything, then I have calculated this as per 115 BAC. If the question is silent, what is more beneficial? We will take as per 115 BAC. So total income is 21 lakh, deduction of expense 18 lakh is the net income, and in new regime you apply on 18 lakh, it will be 3 lakh ka 30%, and then plus 187,500, that's the tax up to 15 lakh. Don't tell me that you don't know all this. 15 lakh pe fixed tax 187,500 plus 3 lakh ka 30%, 90,000, and then you add cess, you will get 288,600. If you would have applied special rates, you would have got this as the answer. He is a resident, then you will not get the special rate. So don't make them. Same question, Nadal, tennis professional, non-Indian citizen, all the income data is same. You can read that. It is same question I am telling you, with one difference, that this time he was non-resident. That means now he is non-resident foreign national, non-resident foreign national. That means normal rate or special rate. This time it will go under special rate, and if special rate is applicable, then this time deduction of expense will not be available. So directly 20 lakh ka 21 lakh ka 20% and 4% you add cess. This is same as a sum that we solve in full course in our normal classroom lectures. 436, 800 is going to be your option. This question is also something that we solve in class, in subjective also. Smith, a non-resident cricketer, as a member of Australian touring team, received a sum of 5 lakhs for participation in matches in India. He also received a sum of 1 lakh for an advertisement of a product on TV. He contributed articles for which he received 10,000, and during the tour he attended horse racing in Mumbai and he won a prize of 20,000. No other income. So now see, he is non-resident foreign national. Non-resident foreign national. That means special rate will apply. So there is 5 lakh, 1 lakh, 6, 10,000, 610 and 20. 630 is the total income. Will you apply 20? Nahi re gada, here you can make a mistake. This 20,000 will be taxable at a rate of 30% because it is casual winnings. All other incomes will be taxable at 20%. So how are we going to solve it? 6 lakh 10,000 will be taxed at 20%, being foreign national sportsmen for game or sport articles in media and advertisement, and casual winnings at 30%. So that's our basic tax. Add cess, and 133, 120 will be your answer. 133, 120, 31 ka answer. In the above question, if TDS is fully deducted, will he have to file return? No other income TDS is deducted. Yes, he will file his return because he has casual winnings. Yes, he will file his return because he has got casual winnings. That facility, abhi thode time pehle I told you 115A, AC, BBA and G. Yes, casual winning. But wait, if you choose B as your answer, it will be wrong. Not required is not the answer. B is right, sir, then why you are saying it is wrong? Listen, if the total income of an individual is less than the basic exemption limit, then as per 139(1), return filing is not compulsory only. So when we say return filing is compulsory, he should also fall in that criteria, no? JTI more than basic exemption, or ROR having foreign asset, anything like that. So this is also a reason. Supposingly the total which is coming to 630 was only 63,000 rupees. Then what will be your answer? No ROI. So yes, he has casual winnings, so the immunity is not available and his income is exceeding basic exemption. B and C both are the reasons, and thus answer to be chosen is D. Most appropriate answer will be D. B is right, but B is one of the conditions. C is also a condition. If you ignore this condition, you will end up choosing B. You will lose your marks. In the above question, if Smith is an umpire, then what will happen? If for umpire we will not apply special rate, we will apply slab rates, but still casual winning will go in 30. So casual winning के लिए we will apply 30 only, and 610 which was earlier taxed at 20 will now be taxed at slabs. I have applied new regime because no information about any benefit taken has been given, so I have applied new regime for you. Here you apply new regime on 610, you will get 23,500, 29,500 plus 4%, 30,680 will be your answer, because for umpire slab rate is going to be applicable, sportsman wala rate not applicable. Interest income earned by a non-resident during the previous year 21-22 on bonds issued by ABC Limited, an Indian company, under a scheme notified by central government, which were purchased. So notified bonds taxable at 10%, 115 AC. FII has total income which includes short-term capital gain on the sale of preference shares. What will be the rate of tax? See, for FII, short-term capital gain, two rates. If it is a 111A case, then 15, otherwise 30. And 111A covers only equity shares, units of equity in mutual fund, units of business trust. That means preference shares are not covered, and accordingly preference shares ke liye 30%. Rate of deduction of TDS from interest payable to a foreign company located in a country with which there is no DTAA by an Indian company on borrowing made from the said foreign company by way of rupee denominated bonds issued on 31st March 19. Now you will say, sir, rupee denominated bonds का 5% plus surcharge HEC मेरे को मालूम है sir. 5% plus surcharge if applicable and HEC. So C is my answer, sir. एक चीज याद दिलाता हूँ. I would like to remind you, you may not remember. Rupee, इतना depth में I have tested you here. Rupee denominated bonds which are issued during this period. Then that interest is exempt, and if interest is exempt, the TDS will be 0. If it is issued from 1st April, then 5% will be applicable from 1st April 19 onwards. That also in IFSC from 1st September 19 it was exempt, and then from 1st April 20 auntie made it 4%. So many amendments, but we have all studied this in 115A in our full course lecture. Full course is where I explain everything. Here we are solving questions on things that we have already studied. Interest income earned by Mr. George, a non-resident and citizen of Australia during the previous year 21-22. Bonds issued by MNO and Indian Limited under a scheme notified by central government, that is once again notified bonds, so taxable at 10%. P Limited is a domestic company which filed its return of income for AY 22-23, declaring total income of 1 crore 15 lakh. The assessment in its case was opened by the AO by issuing notice under 143.2. The AO doubted the genuineness of the loans taken by the company and added the amount of 5 lakh to the total income as cash credit. What will be the effective tax rate on 5 lakh? Whenever there is unexplained cash credit, what will be the effective tax rate? 30, 78%. So 60 plus 25% surcharge plus 4% cess, if you observe 78. Non-resident earning interest from municipal debt securities. It's also an exception in 115A, so it will fall in the rate of 5%. Non-resident earning interest from rupee denominated bonds on IFSC on 1/4/20. From 1st September 19 to 31st March 20, it was exempt, but now auntie has said it will be taxable at 4%. Chapter 12 will be applicable even in new taxation regime. Yes, new taxation regime says nothing in income tax is applicable except chapter 12, so it will be yes applicable. X and company and Y and company are non-resident firms and they are receiving fees for technical services of 20 lakh each in previous year 21-22. So non-resident receiving FTS 115A 10% income, 10% tax. A Limited in pursuance of an agreement with A Limited approved by central government. X and company does not have any fixed place of business or profession, whereas Y and company has a fixed place of business and profession in India, and the contract is effectively connected with such permanent establishment. Listen, if the foreign company or the non-resident has got PE in India, maintains books of account and gets it audited, then you have an option of taking 44DA with expenses. So that option we will give to Y and company. But if you do not have any permanent establishment, then there is only one option, directly 10% on gross income. Okay, both of them have received the 20 lakhs. So as far as X and company is concerned, I can directly calculate the tax. Under 115A directly we will apply for X and company 10%. So that will be 2 lakh, and you add 4% cess, you will get 2 lakh 8,000. Okay. The revenue expenditure incurred by X and company is 2 lakh. Once you are in special rates 115A, no deduction of expense. So 20 lakh will be directly taxable. Following are the details pertaining to Y and company. So for Y and company, expenses are given, we will get deduction. Revenue expenditure incurred 3 lakh 50. Expenditure wholly and exclusively connected with the PE of the above amount 350 is only 3 lakh. When we give deduction of expense in 44DA, we give deduction only and only of expenses which are incurred in connection with the permanent establishment. In connection. So we will not give deduction of 350. We will give deduction only of 3 lakh rupees, or if there is any head office expenditure as reimbursement of our actual. So there was actual expense in the PE paid by head office and we reimburse. That will be allowed because it is again actual expense. Okay. Amount paid by fixed place of profession to head office otherwise than actual expense. So this will also not be allowed. So 350 fully not allowed, only exclusive expense of the PE will be allowed, and head office reimbursement. If it is our actual expense, then it will be allowed, but this is other than actual expense. So this also not allowed, this also not. Only 3 lakh deduction will be allowed from 20 lakh. Books are maintained and books are audited also. What is tax liability for X and company, Y and company? 4 options are given. For X and company, if you observe 20 lakh, no deduction of expense because 115A will apply. 10% will be 2 lakh and 4% 2 lakh 8,000. Now in all the 4 options, if you observe carefully, 2 lakh 8,000 is given only in option C. I can stop here. If you use your brain, no? If you use 100% of your brain, you realize that C is only the correct answer, even without calculating the tax of Y and company. But let's actually calculate. X and company ka 20 lakh directly at 10% plus 4% 2 lakh, and Y and company is a partnership firm. So after taking deduction of only 3 lakh, why only 3 lakh? Only actual expense of PE or head office expense if it is reimbursement of actual expense, but this is not reimbursement. So head office expense not allowed. Only actual expense of PE will be allowed. So we will take deduction of 3 lakh and we will apply normal rate. Now normal rate for partnership firms is 30%. So 115A will not apply in 44DA. This is 115A, and in 44DA we take deduction of expense and apply normal rate of tax. So for firm, what is the normal rate of tax? 30, add cess, you get 53400, which is also matching. Even if you wouldn't have done it, 2 lakh 8,000 you are getting only in C option. So anyways, C had to be selected. M Limited and N Limited are Indian companies which have to pay interest of 2 lakhs and 1 lakh outside India to Mr. P, a non-resident, during the previous year 21-22 on rupee denominated bonds issued in January 19 and April 19. This is going to make a massive difference. M Limited is issuing in this month and N is issuing in this month. What is the difference? Arey, abhi to bola tha period. So anything issued in January 19, which is issued by M Limited, it will be exempt. And anything issued in April 19, after that date March went away, it will be taxable. That means the interest which M Limited is paying 2 lakh, that will be exempt for Mr. P, and the interest which N Limited is paying, that will be taxable for Mr. P. Which of the following statements are correct relating to liability of M and N to deduct TDS? Both have to deduct? No. Both do not have to deduct? No. Both have to deduct? No. M Limited does not have to deduct. Why? Because that interest is exempt. And N has to deduct 5% basic and 4% cess, so net 5.2. This is your correct option. Only those students who know that date, that cutoff date, 31st March 19, will be able to understand. Mr. Mahesh is found to be owner of 2 gold chains of 50 grams each, market value of which is 1,45,000 each, during the financial year ending 31st March 22. But he could offer satisfactory explanation of only 50,000. That means, can I say, out of the total value 50,000 is explained, remaining is unexplained? What will be the liability? Please understand. 145 is per gold chain. So what is the total amount? 290. 290 ke andar you have given 145 at 145. 290 mein se you have given explanation of 50. So 240 will be taxable at 78%. Don't do 145 minus 50. You'll go wrong. It is each. One word. Each. And explanation of 50. So unexplained is 240, and 240 ka 78% you apply, you will get this answer 187,200. XYZ of FII has total income comprising of short-term capital gain on sale of listed preference shares. Preference shares means 30% will apply because not covered in 111A. And interest income referred to under section 194 LD of 15 lakh. 194 LD means earned as QFI. 194 LD means earned as QFI. QFI matlab this will be taxable at 5%, this will be taxable at 30%. So we will apply on 15 lakh 5% because it is earned as QFI, 50 lakh 30% because it is not 111A, that's basic tax. 1575, this also I have given in the option, but you have to add cess, and after adding cess 1638 is the only option that you will be getting as the right option. Mr. Ranveer, a non-resident, earned income of 6,20,000 during the previous year 21-22 on bonds issued by Tilt Limited, an Indian company notified under a scheme by central government, which were purchased by him in convertible foreign currency. That means, once again, can I say notified bonds are given? Notified bonds means 115 AC 10%. See, all other sections only 10 was given, we chose that. But if they give us which says, then that is more appropriate. In any option they give us 10 and 10.4 both, then 10.4 is the more appropriate answer. Mr. X, a non-resident, is due to receive interest of 5 lakh during March 22 from a notified infrastructure debt fund eligible for exemption in 1047. He incurred expense of 10,000 for earning such income. Assuming he is a resident of NJA, determine the tax payable and TDS deductible. One thing we all know, that any resident of NJA, the TDS has to be minimum 30% plus cess, surcharge if applicable. So if the TDS is 30 and cess, I am sure that option is option A only, even if I don't calculate tax. But for safety, let's calculate tax. 5 lakh is the income, 10,000 is the expense. Special rate means no deduction of expense. So 5 lakh will be taxable. And interest from notified infrastructure debt fund, again an exception in 115A. So this interest will be taxable at a rate of 5%, 25,000 plus cess of 4%. So 26,000 will be, anyways, we already know that TDS is 31.2. So that only has to be the answer. Interest income earned by non-resident during previous year 21-22 on bonds issued by ABC Limited, an Indian company notified under a scheme by central government, which were purchased by him in convertible foreign currency. So again it is going to be taxable at 10%. Aparna and Dimple, Indian citizens residing in California since 2011, visit India for 60 days every year. Visited. On 1/3/22, Aparna transferred to Dimple in California for consideration equal to $15 lakh rupee denominated bonds issued outside India of X Limited, a company incorporated in India, which were acquired on 1/3/19 for a price of dollar equivalent to 10 lakh. What is the capital gain? Transfer is outside India by one non-resident to another non-resident. The asset transferred is the rupee denominated bond. The asset transferred is outside India. Everything is outside India, and thus, like we saw in that ADR GDR wala question, there is no capital gain that will be attracted. No capital gain that will be attracted. ABC Incorporation, a company whose place of effective management is outside India, receives royalty from A Limited, an Indian company, in pursuance of an agreement made which is approved by the central government. XYZ Incorporation, a country B company whose place of effective management is outside India, received fees for technical services from A Limited in pursuance of an agreement which is approved by central government. So ABC is from country A and XYZ is from country B. ABC is getting royalty, XYZ is getting FTS. Both are taxable at 10% in 115A. The DTAA between India and country A provide that royalty will be subject to tax at 9%. That means normal rate of tax as per Income Tax Act is 10% 115A and DTAA rate is 9%. So Income Tax Act or DTAA, what will be chosen by ABC? Obviously whichever is beneficial. And DTAA between India and country B provide that FTS will be subject to tax in the source state at 12%. So if I talk about country B, then normal rate of tax for FTS is 10%, DTAA is 12. That means, can I say here we are choosing DTAA for this assessee will pay tax as per DTAA and this assessee will pay tax as per 115A, because both will choose whichever is beneficial to them. Both of them do not have any permanent establishment in India. ABC and XYZ also invested in shares of Indian companies in respect of which they receive dividend. So this dividend also will be of course covered under 115A, because foreign company ka dividend income is also covered in 115A. Dividend, interest, royalty, FTS, mutual fund profits, multiple incomes are covered. The treaty states that dividend will be taxed at the rates provided in domestic law. So dono ka dividend will be taxable as per 115A only, which is 20%. Only business trust ka dividend is taxable at 10%, otherwise it will be 20%. Are ABC and XYZ required to file their return of income assuming that TDS is fully deducted. In 115A, there is a provision. No other income TDS is fully deducted. No other income TDS is fully deducted. First of all, TDS is deducted. Secondly, we have to check, is there any income other than 115A? This dividend is a case of 115A. Now let's talk about the royalty FTS income. Okay. As far as this XYZ incorporation is concerned, it is paying tax as per 115A. It is not availing DTAA. That means it has got two incomes. FTS as per 115A, dividend as per 115A. Both according to 115A, TDS deducted. That means no other income TDS deducted. No need to file ROI. This will not file ROI, XYZ. Let's talk about ABC. Dividend is 115A, but royalty, you are not paying tax as per 115A. Royalty mein, you are paying tax as per DTAA. The facility of not filing ROI is if you are paying tax as per 115A, but you are paying tax as per DTAA. That means this company has to file ROI. This company will not file ROI. XYZ will not file ROI. XYZ will not file ROI, and ABC, which is paying tax as per DTAA, will be filing the ROI. ABC will have to file ROI because it is having DTAA income, and XYZ does not have any other income. So both have to file ROI. Wrong. Both need not file ROI. Wrong. ABC has to file, but XYZ need not file. ABC has to file, but XYZ need not file. That is going to be your answer. 50 ka answer C. Mr. Pranav, a resident age 48 years, and his brother, a non-resident age 45 years, received dividend of 7 lakh and 5 lakh respectively from A Limited, an Indian company, in January 22. The interest expenditure incurred by them in previous year 21-22 on loan taken for investing in shares of A Limited. For Pranav it is 1.5 and for Vaibhav it is 80. What is the tax payable by them on such income? Assuming it is the only source of income of Pranav and Vaibhav. That means they don't have any other income and they wish to make maximum tax savings. First of all, Vaibhav is a non-resident and non-resident ka dividend income will come in 115A. See how deeply you have been tested. What they are expecting from you. 115A. 115A means no deduction of expense. Directly we will apply 20%. Vaibhav ke liye we will apply 5 lakh ka 20% directly and we will add cess. So Vaibhav ka tax has to be 1 lakh 4,000. 5 lakh ka 20%, 1 lakh add cess, and I know that my answer is D. But for Pranav, let us still see what they want you to know. 7 lakh is the income. He will go in normal rates of tax because he is a resident, non-resident special rate. Resident will go in normal rate. So you will give deduction of expense. Against, now IFOS ka chapter is also tested. Against dividend income, only interest is allowed and that also restricted to 20%. So 150 ka deduction nahi milega. 150 you won't get. Vaibhav 5 lakh income, no deduction of expense, 5 lakh at 20 plus 4, 1 lakh 4,000. Pranav, dividend income 7 lakh. Deduction will be maximum 20% of your income. Maximum 20. Only interest restricted to 20. And 560 pe when you apply new regime. 60,000 at 10%, so 6,000 plus 12,500 and plus cess 19,240 is going to be your answer. 19,240 will be your answer. That we have already checked because Vaibhav ka, if you don't go wrong, you don't give deduction of expense and you remember 115A, automatically, see, you have to remember non-resident 115A, no deduction of expense. Resident will get but restricted to 20%. So if you go wrong in any place, you may end up doing this wrongly. Well, that's our chapter called Special Rates of Tax. Let's then go ahead. We have got enough time that we can do some more chapters. Some of the upcoming chapters are anyways small chapters only, so we can try and complete them. Buyback tax. M Private Limited, an unlisted company, bought back shares from its shareholders. What will be the tax treatment? Earlier only unlisted shares had buyback. Now to listed, unlisted, all will suffer buyback tax, and thus the company will have to pay tax of 20% is basic. We know that here there is compulsory surcharge and compulsory cess, but we will check only the basic tax, and that is going to be in the options that they have given here. We can check only the basic tax, so we will choose D. Shareholders are not required to pay. For them, the capital gain will be exempt. When an unlisted company buys back its shares, it is required to pay tax on distributed income, which is consideration paid minus the amount received for issue of shares. Now, if the shares were issued as ESOP, so see basically what is the calculation of buyback tax? Buyback price is the selling price Cost price you have to take as per capital gain. So you need to know knowledge, you need to have knowledge of capital gain. As per capital gain, what is cost price of shares received as ESOP? The fair market value on the date. So that is going to be the cost of acquisition that you will be taking. Mr. Bhavesh, a shareholder, holds 12% in ABC Private Limited, which is not listed on stock exchange, received consideration of 50,000 on 16th August 21 for buyback of shares of ABC Private Limited, which was acquired by Bhavesh on 26 July 2012 for 30,000. Tax treatment of rupees 50,000 in the hand of Bhavesh will be what? For Bhavesh it will be exempt, because once the company will pay buyback tax, there will be no tax on Bhavesh. When an unlisted company buys back its shares, it is required to pay tax on distributed income, which is consideration paid minus amount received. Now where the shares were received as bonus shares, then the amount will be taken as basically again the cost as per capital gain. So you have to take the cost as 0. When unlisted company buys back its shares, it is required to pay tax on distributed income, which is consideration paid minus amount received for issue of shares. Now where the shares have been issued on conversion of preference shares, then what will be the cost price that you will be taking? Again capital gain rule. If preference shares are converted into equity shares, then the cost of preference shares will be taken as the cost of equity shares under capital gain. Rate of income tax to be payable by securitization trust. So securitization trust ka small explanation I will give you. You know what is business trust, investment fund and all. What is a securitization trust? Securitization trust basically does the business of buying of debtors. Your company has got 10 lakh ka debtors and you are not sure how you will be able to recover, when you will be able to recover. They will give you an offer. Take 7 lakh rupees and we buy all your debtors. Means now recovery we will do. What's our business? It's a risk. See, first of all, what's your benefit? 10 lakh is doubtful. You are getting 7 lakh. You're like, chod, give 7 lakh. At least I'm getting that much. Like a normal loss, you will treat it. And now what company, this company will do? This will do recovery from those debtors. They will send their agents, they will send gundas, mawalis, they will do that recovery. If they recover more than 7 lakh, that's the profit of the company. And they will do that analysis. That how much we expect. 10 lakh is the debtors, they will do analysis. We expect to recover say 8 lakhs. So we can give an offer of 6 lakh, 7 lakh, something like that. That's the business. So what happens? First, people will invest in the securitization trust, because to buy those debtors, we will need money, no? Just like people invest in business trust, investment fund, any mutual fund, people will invest. We call them investors, unit holders. Securitization trust will get money. With that money, securitization trust will buy debtors. Now they will do recovery. Then we will find out profit and that profit will be distributed. Sir, why we don't cover it as a separate chapter? Because as a rule, securitization trust will not be paying any tax. Whatever is the profit, it will be taxable for the unit holder. See, in business trust, some incomes are taxable for business trust, some for unit holder. In investment fund, PGBP for investment fund, others for unit holder. But here, all incomes are taxable for the investors, for the unit holders, and the securitization trust will deduct TDS. What is the TDS that will be deducted? Orally, I will tell you. If the investor is individual HUF, then 25%. If the investor is other than individual HUF, then 30%. All the incomes will be taxable for the investor and securitization trust will be deducting TDS, 25% of individual HUF and 30% for others. So what is the rate of tax of securitization trust? Nothing, because who will pay tax? Investor. Tax on income of securitization trust is paid by whom? The investor. Securitization trust earned interest income from A Limited 2 crore. It distributed rupees 10 lakh to one of its investors K. In the given scenario, who will deduct TDS? C. A Limited will not deduct TDS because trust ka income is exempt. But trust will deduct TDS because investor ka income is taxable. And what will be the rate of TDS? For individual HUF, we will be applying 25%, and for other than individual HUF, we will be applying 30%. Rate of TDS to be deducted by securitization trust on distribution of income to investor, which is a firm. For firm, we will apply 30% TDS. Lima Limited, a domestic company, purchases its own unlisted shares on 13th August. The consideration for buyback amounted to 23 lakh rupees, which was paid on the same day. Amount received by the company 2 years back for the issue of shares determined in the manner specified is 17. That means, can I say the buyback price 23 and the purchase price 17? In other words, 6 lakh ke upar you have to calculate 20%. Compulsory surcharge 12% in buyback tax, compulsory HEC. If you apply 20% plus 12% plus 4%, you can apply no, here only 6 lakh. 139,776 will be your answer. 139,776. Surcharge on buyback tax will be Only if profit exceeds 1 crore, distribution exceeds 1 crore, both K always, here it is going to be always applicable. What is the surcharge? Already calculated, 12%. Dividend received from a non-domestic company, see dividend is taxable, but if it's a foreign dividend, it can be taxable only for resident. Dividend received from a non-domestic company shall be exempt up to what? Is there any exemption, any threshold? No. It is fully taxable, but is it fully taxable for both resident and NR? No. Foreign dividend can be taxable only for non-resident. Foreign dividend can be taxable only for resident. Any foreign income can be taxable only for resident. X acquired 1000 shares of ABC Limited at 10 each at a premium of 50. So can I say purchase price is 10 plus 50, 60 rupees is total on 1416. The company under a scheme of buyback purchased back 500 shares from X on 10th April 21 at a buyback price of 70. Okay, so buyback price is 70, purchase price is 60, 10 rupees into, please focus, shares bought back are only 500, not 1000, 500. That's the profit 5000 and iske upar you apply 20% compulsory surcharge and 4%, you will get 1165. Actually, this is also a classroom question that we do in full course. A Limited, an Indian company, bought back its listed shares from its shareholders, and B Limited, an Indian company, bought back its unlisted shares from its shareholders in the month of March 22. What are the tax consequences? See, once upon a time only unlisted shares had buyback. Now do we know that whether the shares are listed or unlisted, both are going to suffer buyback tax, and that means additional income tax of 23.296, that's the net rate that is given, is leviable in the hands of A Limited as well as B Limited. Both companies are liable for additional. XYZ Limited, a domestic company, purchased its own listed shares on 20th November 2021. Consideration paid for buyback is 24 lakh. The amount received by the company 2 years ago for this shares was 13 lakh. That means, can I say 24 minus 13, 11 lakh. Compute the additional income tax payable. So we have to apply on this 11 lakh 20% plus 12% plus 4%. Compute interest, if any, payable if such tax is paid to the government on 3rd December. First, let's calculate the basic tax so that some options we can eliminate. 11 lakh ke upar, if we apply 20%, compulsory 12% surcharge and 4% cess, 256. So this is wrong. This is wrong. Our buyback tax liability is coming to 2,56,256. Now, what is the interest? Whenever you pay the buyback tax late, not paid within 14 days. So 1% interest is attracted, but check, no, this was 20th November. So we have time of 14 days up to 4th December if we pay no interest, and this was paid on 3rd December. And if it was paid on 3rd December, then there cannot be any interest. Interest will be 0. If it was paid on 5th December, if I change this date, then 1 day delay. 1 day delay means 1 month interest. So 1 month interest we will have to calculate 256 into 1%. Then our answer would have been D. But here it will be, of course, A. Next chapter, Special Economic Zone. Very small chapter. Units established in SEZ are eligible for exemption under section 10AA of dash profits for first 5 years and dash for further 5 years. First 5 years 100 and next 5 years 50. Yes or no? Last year to commence the business for availing SEZ benefit. The business commencement ka rule was previous year 5-6 to previous year 1920. Commencement, then you can get 15 years. 5-6 to 1920. So last year to start is 1920. And business should commence on or after first year was 5-6. So first year was 5-6 and last year was 1920. To avail the benefit of 10AA, which condition has to be satisfied? CA report is compulsory, return on time, and maximum second hand plant and machinery 20%. In other words, all are the conditions. SEZ is a very small chapter and it gets over here. Let's go ahead to our next chapter, taxation of business trust. We are going in the order of our main textbook only. The MCQ book is made also in the order of our main textbook. Which of the following income is not exempt in the hands of REIT? Just a reminder, interest from SPV, dividend from SPV, rent. Interest from SPV, dividend from SPV, rent. These three will be exempt for REIT, taxable for unit holder. But dividend is taxable only if SPV has opted for new regime 115BAA. If the SPV is in old regime, so dividend will also be exempt. So which is not exempt for REIT? Interest received from company is not exempt. Interest received from SPV is exempt. Rent from own property is exempt. That means this is the only income which is not exempt. Rent received from own building by REIT and then distributed to investors will be taxable for whom? Rent is exempt for REIT and thus it will be taxable for the investors, unit holders. State whether the following statement is true or false. Units of REIT shall be mandatorily listed on stock exchange. See, earlier as per SEBI regulations it had to be mandatorily listed, but now it is not compulsory. Short term capital gain on sale of property 10 lakh earned by business trust. The income is distributed to unit holders. Rate of tax payable by unit holder will be exempt होएगा ना. So listen, 3 incomes REIT will take exemption and unit holder will pay tax. All other incomes, whether it is short term capital gain, long term capital gain, any general interest, dividend from non-SPV, interest from non-SPV, everything REIT will pay tax, unit holder will not. Unit holder will pay tax on only those 3 incomes which REIT is taking exemption. Interest of 1,50,000 received from government securities, rate of tax will be MMR. What is the tax rate of REIT? MMR. Khali 111 hai, 112 benefit it can take. Otherwise, maximum marginal rate 42.744 is going to be the rate of tax. Mr. Kalu, a resident, purchased units of business trust on 7/7/17 for 3 lakh. He sold this on 11/11/21 for 9 lakh. That means, can I say more than 36 months? So, long term capital gain, no other income. What is the income tax payable? They are not asking you the income, they are asking the tax payable. So, we will have to find out capital gain. Just a reminder, this is long term, first of all, more than 36, and business trust will fall in 112A. Equity shares, units of equity on mutual fund, units of business trust. And once you are in 112A, that means no indexation. So, one thing is for sure, 6 lakh is the capital gain, 9 minus 3, no indexation. But on that 6 lakh, if you apply 20%, you are gone. Why you are gone? Because 112A is not 20, 112 is 20. 112A is what? First 1 lakh 0, balance 5 lakh, 10%. If you do that also, no, you are still gone. You know why? 2 people, 3 incomes. 2 people, 3 incomes. Resident individual in 112A. Let me show you what. Sale consideration 9 lakh, cost 3 lakh. So, what's the long term capital gain? 6 lakh. First, utilize your unexhausted basic exemption limit. And you pay tax only on the remaining 350. And on the remaining 350, first 1 lakh will be 0. 250 will be taxed at 10% and add 4% cess. First unexhausted basic exemption, then 1 lakh ka benefit, together will make it 250 ka 10% plus 4% cess, 26,000 will be your answer. REIT received rental income on own properties 1 crore 5 lakh and distributed the same to unit holders. What is the tax payable by unit holder? Unit holder will pay tax on this. For resident unit holders, all incomes are taxable at normal rates and TDS is 10%. For non-resident unit holder, dividend is 10%, interest is 5% and rent is applicable rates, and for non-resident TDS will be same as the rate of tax, but for rent it is both resident as well as non-resident taxable at normal rates. Business trust paid 5 lakh as interest to unit holders received from SPV. TDS required to be deducted at dash for resident, non-resident and dash for non-resident. For resident all the TDS will be 10. For non-resident, what is the rate of tax? That is only TDS 5%. But surcharge and cess will be added. So, for resident it will be 10%. So, we have only A and D left. And in that non-resident, because it is interest income, we will apply this. If it was rental income, then D will be our answer. If you understand what I am saying. Okay. Statement of income distributed by a business trust to its unit holders has to be furnished. Whenever a business trust is distributing any income to its unit holders, it has to give a statement. It is given in the rules. If you want, you can read, otherwise you can ignore also this one question. Dividend received from a company which is not a special purpose vehicle by business trust and further distributed to unit holders is in the hands of the business trust. What is the answer? And for the unit holder, what is the answer? Any company which is not a special purpose vehicle, non-SPV. See, business trust gets exemption only if it is SPV. Business trust will get exemption only if it is SPV. Not SPV means business trust ke liye it will be taxable and unit holder ke liye it is exempt. Business trust ke liye it is taxable and unit holder ke liye exempt. And this is one option which has been wrongly printed. So, the answer that is printed is B. You cancel that. The correct answer is C. Couple of students already message me on WhatsApp, sir, there is an error. I already told them that I will announce this in the MCQ lecture. So yes, the answer is C, taxable and exempt. Short term taxable for the business trust because it is non-SPV, and exempt for the unit holder. Short term capital gain other than the gain on sale of listed shares would be subjected to tax in the business trust at the rate of MMR. See, only 111A, 112 is eligible, otherwise MMR. Business trust hold 51% equity share capital in special purpose vehicle. SPV is a company regulated under the Companies Act 2013. It paid dividend of 12 lakh to business trust. Tax treatment for business trust will be what? See, SPV, if it opts for new regime, then unit holder will pay tax. If it does not opt for new regime, then unit holder also will not pay tax. But under all circumstances, for the business trust, it is going to be exempt. Business trust के लिए all circumstances exempt. TDS at dash in case of distribution to resident unit holder of, see, whenever any distribution is to resident, no, it will be 10%. TDS at dash in case of distribution to non-resident unit holder in case of rental income. See, non-resident के लिए rate of tax equal to TDS, and special rate is prescribed only for dividend and interest. So for rent, it will be the applicable rates in force. Capital gain on disposal of assets by business trust distributed to unit holder. Such capital gain in the hands of the unit holder obviously will be exempt, because except 3 incomes, all other incomes business trust has already paid tax. Short term capital gain of 1 crore on sale of developmental properties earned by business trust, and the same is distributed to unit holder. What will be the tax liability for unit holder? Again, it will be 0, because business trust has already paid tax. Dividend received by a real estate investment trust from special purpose vehicle and distributed to unit holders. Exempt for both REIT and unit holder, wrong. REIT के लिए it is unconditionally exempt. Unit holder will get exemption when? If SPV has paid tax in old regime, then unit holder will not pay tax, and SPV has paid tax in new regime, then unit holder will pay tax. Exempt in the hands of REIT only if SPV is a specified domestic. No, REIT के लिए it is going to be a blanket exemption. Wrong. Exempt in the hands of REIT. Correct. Exempt in the hands of unit holder only if SPV does not exercise the 115BAA option. If it exercises, then it will be taxable. This is the most appropriate answer, and taxable in the hands of REIT is also wrong only. So C is the answer. REIT derives rental income of 2 crore from real estate property owned by it, and short-term capital gain of 1 crore on sale of developmental properties. It also receives interest income of 3 crore from Gamma Limited, an Indian company in which it holds controlling interest. The REIT holds 80% of the shareholding of Gamma Limited. Which of the following statement is correct? All incomes are taxable in the hands of the REIT. Wrong. See, this is going to be taxable for the unit holder. Short-term capital gain is taxable for REIT, and interest from SPV is also taxable for unit holder. REIT enjoys pass through. Wrong. REIT के लिए short term capital gain is taxable. REIT enjoys pass through in respect of interest income from Gamma Limited, and hence that is taxable in the hands of unit holders. That's right. Rental income and short term capital gain are taxable for REIT. Again wrong, because REIT will pay tax only on short term capital. REIT enjoys pass-through status in respect of this interest from SPV and rental income. In fact, this is the only option left, and hence such income is taxable for unit holder. Yes, we already decided this income and this income for unit holder. Short-term capital gain is taxable for the REIT. Rate of income distribution tax on REIT not applicable. Business trust investment fund, there is no income distribution tax applicable. And REIT has distributed 2 crore to its unit holder, which comprises of rental income of 80 lakh. Rental income of 80 lakh, who will pay tax? Unit holder. Interest income from special purpose vehicle, who will pay tax? Unit holder. Dividend income other than SPV, non-SPV, who will pay tax? Business trust. Capital gain, who will pay tax? Business trust. Correct or no? You just need to know the taxability and you will understand what I am saying. In this case, special purpose vehicle is an Indian company in which REIT holds 100%. Which of the following statements are correct? So they have given you multiple statements, and then you have to decide out of them which is correct. All above incomes are taxable for REIT. 1 is wrong. Is there any option where 1 is the answer? Wrong. This cannot be our option. Only income referred to in 1 and 2 are taxable for REIT. 3 and 4 are unit holder. Wrong. We have decided 1 and 2 are taxable for unit holder. 3 and 4 are taxable for REIT. That means 2 is also wrong. Any option having 2? Wrong. Only income referred to 1 and 2 are taxable for REIT. Again wrong. Income referred to in 4 is taxable for unit holder, 3 is rubbish. REIT will pay tax on 3 and 4, we have decided. This is also wrong. 3 hai kya option? Lol. Arey already pata hai that D is the option. You want to save time? D is the option. Ho gaya. Only income referred to in 3 and 4 are taxable for REIT. Correct or no? 3 and 4 are taxable for REIT. And income referred to in 1 and 2 is taxable for unit holder. That means 4 has to be correct answer. Because 4 and 5 are given here. So this is right. Tax is deductible by REIT of 1 and 2. Of course, those two incomes are taxable for unit holder. So TDS will be deducted. Yes. And 4 and 5 are together. So it has to be right. And 6, 7, 8 definitely are wrong only. Let's see. Tax is deductible by REIT for 3 and 4. No. Unit holder is not going to pay tax. 3 and 4 I will pay tax. Then why I will deduct TDS? Tax is deductible on 4? No. No tax is deductible. No. 1 and 2 pe deduct karna hai. And accordingly, anyways, we have decided 4 and 5 are right. Dividend received by real estate investment trust from a company other than special purpose vehicle, non-SPV, is taxable. For whom? Non-SPV is always going to be taxable for the REIT. Always for the REIT. SPV we will check unit holders ke liye, old regime or new regime, non-SPV. Now we have a case study based question on business trust. So 22, 23, 24, 25, 26. 5 questions which are given over here. 5 questions we have to answer. Case study based. Business trust registered under SEBI REIT regulations gives you the following particulars of its income for the previous year 21-22. What are the incomes given? Interest income from Z Limited 10 lakh, dividend income from Z Limited 5 lakh, short term capital gain on sale of listed shares STT paid on Indian companies 4 lakh, short term capital gain on sale of developmental properties 8 lakh, interest received from investment in unlisted debentures of real estate companies 1 lakh, rental income from directly owned real estate assets 20 lakh. Z Limited is an Indian company in which business trust holds 100% of the shareholding. मतलब SPV है and has opted for the taxation regime under 115BAA. मतलब SPV is in new regime and that means unit holder will pay tax on dividend. If SPV is in old regime then dividend is exempt. तो देख लेते हैं. Interest from Z Limited, interest income तो unit holder will only pay tax. Dividend income also unit holder will pay tax because it is in new regime. अगर ये old regime में होता then no one will pay tax. REIT will definitely not pay tax. Short term capital gain तो पक्का business trust has to pay tax. Short term capital gain again business trust will pay tax. Difference is this will be at 15% and this will be at MMR. Interest from general interest, this will also be MMR, and rental income unit holder will pay tax. Correct or no? Mr. X is the assume that business trust has distributed entire 48 lakh to the unit holders for previous year 21-22. Mr. X is a resident unit holder having 100 units. Of course, he will get in his share. And Y is a non-resident unit holder holding 500 units. Total units are 5,000. Total units are 5,000 in which X is having 100. That means I think X is 2%, you can check. And non-resident Y is having 10%. X is having 2% holding, Y is having 10% holding. So 48 lakh ka all these incomes ka X will get 2% share, Y will get 10% share. Now let's answer the questions. In respect of the component of interest income from Z Limited distributed by the business trust, interest income of Z Limited, we have already decided unit holder will pay tax. No tax is deductible. No, tax will be deductible. The question is on TDS. That means for X we will have blanket 10% because he is resident. But for Y, what is the rate of tax on interest? 5% plus cess. So 5.2%. So no tax, wrong. Tax is deductible at 5% on X. No, X ka 10 hai, Y ka 5.2. Tax is deductible at 10% for X, correct hai? And tax will be deductible at 5.2% for Y. That's our right answer. Resident ka 10%, non-resident ka 5% plus cess, actual rate of tax. In respect of short-term capital gain of 4 lakh on sale of listed shares of Indian company and 8 lakh of developmental properties, we have decided who will pay tax? Listed shares and this short-term capital gain. Both business trust, but this at 15% and this at MMR. Obviously, in 15% there will be cess also. Business trust is liable to pay tax as 15.6. 15.6. Maybe it is right because of cess, but 31.2 is wrong, no, because other than 1118 it will be MMR. Both के लिए 42.744 is wrong. Business trust enjoys pass through is also wrong. It is first short term capital gain 15% plus cess, and second के लिए it is going to be MMR. That's your option. Dividend income of Z Limited distributed to unit holder. So dividend from SPV, unit holder will pay tax because it has opted for new regime. Would be subjected to distribution tax. DDT is removed. Wrong answer. Is exempt for business trust, right? And consequently would be taxable for unit holder as the company has opted for new regime. That's the reason. That's the right answer. But let's read further. Exempt from distribution tax in Z Limited and taxable for business trust. Wrong. Exempt from distribution tax, not taxable for both. Wrong. This is going to be your right answer. Unit holder will be paying tax. Interest received by business trust from investment in unlisted debentures. So anything other than SP will be taxable, and that also will be taxable at MMR. Very easy. In case study 1 or 2 will be very easy. Rental component of income from real estate of business trust and distributed to unit holders. Rental income. This income taxable for unit holder. But what is the rate of tax? Normal rate of tax. Rate will be normal. TDS क्या है? For resident 10% and for non-resident the applicable rate of tax including surcharge and cess. What are they asking? Subject to tax in the hands of business trust. ये तो wrong है because unit holder will pay tax. Subject to tax at the business trust, again wrong. Subject to tax in the hand of the unit holder, X at 10% and Y at the rates in force. Somewhere you will get a feeling that sir this is the right answer because X के लिए 10 and Y के लिए rates in force. No. Tax rate for both is normal rate. TDS rate X का 10%, Y का applicable rate. TDS rate is X का 10%. The rate of tax for both is normal. They have not said subject to TDS. They have said subject to tax. That means this is wrong. Tax rate is not 10 for resident. TDS rate is 10. Subject to tax in the hands of unit holders, X and Y. And TDS has to be deducted at 10% for X and rates in force for Y. That is going to give you your correct answer. That's the depth in which you have been tested. Non-resident is earning dividend income from business trust. Rate will be 10%. If they would have given one more option 10% plus cess, then that will be more appropriate. In this is only the answer. Capital gain arising for unit holder at the time of, when does it arise? When he purchases shares of SPV? No. At the time of exchange? No. Capital gain arises only at the time of actual transfer. In computation of capital gain for unit holder, cost of acquisition will be what? Actual cost of acquisition of shares, FMV or NAV. Whatever is the cost of shares becomes the cost of units. Tax rate on capital gain for unit holder at the time of actual transfer of units will be. If the units are listed, then STT will apply 111A, 112A. And if not, then normal rates. So for short term capital gain slabs and for long term capital gain depends. Both A and B depending on whether they are listed units or unlisted units. Okay. So every detail is being tested. We have in today's lecture covered chapter number 4, 5, 6, 7 and 8. In that maximum time consumed in that big long case study of chapter 4, but there are quite a few such questions that you are going to come across. In the next class we will be doing, of course, investment fund is very small, bonus stripping, partnership, charitable will be covered. They are big chapters. Mostly they will be covered in the next class. With charitable trust, political party, electoral trust are very small. So next lecture ka target will be investment funds, partnership firm, charitable trust, political party, electoral trust. If we have time, we will start questions of math. We don't know whether we will have enough time, but if we have time, we will definitely start questions of math also. So thank you very much for watching. Have a nice time. Thank you very much. Take care. Bye bye. Good night.